Your Excellencies, distinguished guests, ladies and gentlemen, Assalamu alaikum wa rahmatullah and good morning. I would like to welcome you all to Bahrain to the two-day summit on electronic payments. I want to congratulate Bahrain Bourse, EDB, and Tamkeen for organizing this summit. And I also would like to thank the organizers for the nice arrangement. I also would like to thank the sponsors for their support to make it happen. We are living in a world where recent advancements in technology are disrupting almost everything. Business models are being challenged and transformed at a speed that is quite unprecedented. It is possible for a traditional business to do nothing wrong and still find itself out of business within no time. So the question is, how do we remain relevant in the age of disruption? What is expected of a regulator, a bank, an insurance company, or any other business? And how do we fulfill our customers' current and future expectations? In my speech today, I would like to raise some questions as food for thought, and I hope that over the next 2 days, some of these questions will be addressed by the worthy speakers and panelists of this conference. Let me start with the regulators. The fundamental question facing regulators worldwide today is how to balance regulatory prudence and conservatism with innovation and change being brought about by fintech. This is a dilemma that every central bank faces every day. At the CBB, we have had to go through a paradigm shift in our thinking and our approach to risk management, whereby without lowering our guard against future risks, we decided to embrace the fintech phenomena, promote innovation, and eliminate as much as possible opportunities for regulatory arbitrage. We are open to new ways of doing business made possible by fintech, but we are also assessing the risks posed to the system and are keen to find ways to mitigate those risks. In other words, we decided to embrace innovation and manage the resulting risks rather than stifle innovation in order to keep the risk paradigm unchanged. But is that enough, taking into account the high speed at which technological developments are taking place? Another question for the regulators is, what is the long-term impact of lowering the barriers to entry to enable unbridled competition? Would it necessarily be a win-win for both the customer and the business in the long term? What is the guarantee that service quality will not be negatively affected? The telecom industry gives us some interesting insights. When it was deregulated globally in the late 1990s, many countries opened up to competition. In some cases, dozens of small companies sprang up to offer international calling service at a fraction of the price charged by the incumbent operator. However, the flip side was that the voice quality also deteriorated as companies opted for cheaper solutions. The lack of profitability prevented them from investing in infrastructure and service quality. The advent of fintech companies, challenger banks, and others cast a similar shadow on the banking sector. On the other hand, managed competition can do wonders for the customers, the industry, and the economy. Take the Bahrain telecom industry as an example. After the sector was deregulated in 2003, the number of telecommunication companies increased from 1 to 4. More competition drove down prices and increased telecom penetration in the country. Despite the reduction in price, the growth in the market and the introduction of new services resulted in nearly tripling the overall industry revenue from 2003 to 2018. The customer is a clear winner here, but so are the operators and the economy. Coming to the industry, the most important question facing the banks is how to match the service quality, convenience, and cost effectiveness offered by big tech, Google, Apple, Facebook, Amazon, and etc., without compromising on compliance and risk. It seems there is no easy answer. Big tech has been creeping into the bank's territory with a more competitive offering for the customers and a much better customer experience. Take the example of UE Dao, or this is a company in China, and it is specializing on money market fund. They established a money market fund as a repository for leftover cash from online spending. The fund emerged as the world's biggest money market fund within 4 years, and at its peak was doubled in size of the next largest fund. Should this trend be allowed to continue, or should legislation be used to keep big tech away from the regulated financial sector? Should big tech be subjected to the same compliance and risk parameters as banks? Or should these restrictions be relaxed for everyone? Fintech entrepreneurship is in trend these days. Almost every week, we receive applications from fintech companies for inclusion in the regulatory sandbox. While it is heartening to see young talent working hard at their fintech businesses, the future may be less rosy for a number of these startups. With the incumbent banks and other financial sector players fully gear up to embrace fintech in their respective business areas, they will pose a serious threat to the standalone fintech companies. Take the example of SWIFT. Threatened by the payment alternative offered by crypto asset, SWIFT announced its own service, Global Payment Innovation, or GPI, 2 years ago. Today, the payment processing time has reduced from 3 to 5 days to 5 to 30 minutes for most payments. The target is to achieve real-time or near real-time payments. This service is enabling payments worth $300 billion a day and achieved transfer of 40 trillion in 2018, making it the biggest player by a margin. More than 3,500 banks, accounting for 85% of SWIFT's total payments traffic, have committed to adopting GPI. Payments, and especially cross-border payments, are a favorite area for fintech companies. The question is, what are the prospects for e-payment companies when facing competition from fast and cost-effective service from a payment giant like SWIFT? Unless a fintech company becomes a service provider or a partner with the incumbent in a revenue sharing or some other mutually beneficial arrangement, it will be difficult to sustain itself on a standalone basis. This phenomena is not limited to e-payment companies. In all areas, an incumbent ready to embrace new technology is generally more potent and can outturn the startups. When internet arrived, it caused serious damage to the business model of intermediaries and middlemen. For example, online travel booking flourished at the cost of travel agents. Fintech is expected to do the same in the financial sector by enabling the aggregator model. Nowhere is it more pronounced than in the insurance sector, where the insurance broker faces serious competition from insurance aggregators. Think Uber and Airbnb that have become the largest taxi company and the largest accommodation provider without owning a single taxi or hotel. Should we expect Something similar for insurance? What about banking services after the introduction of open banking? Your Excellencies, ladies and gentlemen, thank you for your kind attention. I hope that you will ponder upon these questions during the next 2 days and come up with some guidance on how to navigate the hazy path to the future. I look forward to a productive conference, and thank you.